Hello, friends. Welcome to the video book summary of The Intelligent Investor by Benjamin Graham. I'm Annie from StoryNest VideoBooks, a business director, consultant, author, and a lifelong lover of books. Over the years, I've helped countless businesses craft their stories and build strong, memorable brands. Why this book, The Intelligent Investor, matters. The Intelligent Investor isn't just another book about money, it's considered the Bible of value investing. First published in 1973, its lessons are timeless because they focus on principles, not market fads. Graham teaches readers how to protect themselves from costly mistakes, how to avoid speculation, and how to invest with discipline and patience. The wisdom in this book has guided generations of investors, including Warren Buffett, who calls it the best book on investing ever written. Who should listen? This summary is designed for anyone who wants to build wealth wisely. If you're new to investing and want a safe roadmap, this book is for you. If you're an experienced investor who wants to sharpen judgment and avoid emotional mistakes, this book is for you. This summary is perfect for beginners who want clear, practical guidance on long-term investing, busy professionals and students who want the key lessons without financial jargon, anyone who wants to avoid gambling in markets and instead invest intelligently for steady returns. About the author, Benjamin Graham is known as the father of value investing. Born in 1894 in London and raised in New York, he faced hardship early in life, which shaped his views on financial security. Graham became a brilliant student, top of his class at Columbia University, and then built a remarkable career on Wall Street. He co-founded the Graham-Newman Investment Partnership, which achieved outstanding long-term returns. Beyond managing money, Graham was a beloved teacher whose students included Warren Buffett and other legendary investors. His work, Security Analysis and The Intelligent Investor, set the foundation of modern investing and continues to inspire people to invest with patience, discipline, and courage. Here is lesson number 1. Introduction. What intelligent really means. Friends, you don't need a high IQ to be a smart investor. Graham says intelligence in markets is about discipline, patience, independent thinking, and emotional control. More character than brain power. Even geniuses can stumble. Sir Isaac Newton doubled his money in the South Sea Company, sold, then, swept up by crowd enthusiasm, bought back higher, and lost a fortune. He could chart the stars, but not human impulses. Brilliant scientist, poor investor. Before Graham, Wall Street often felt like a guild of hunches and superstition. His work brought structure and clarity, turning investing into a profession. Graham's life shaped his ideas. Born in London, moved to New York, rose from hardship after his father's death, studied on scholarship, and built the Graham-Newman Partnership, averaging strong returns even through the Great Crash. This book teaches practical ways to reduce risk, pick securities wisely, and manage yourself. First published in 1973, its insights still guide investors today. Warren Buffett calls it the best investing book ever written. Here is lesson number 2, investment versus. Speculation brokers earn whether you win or lose. You must know which game you're playing. Speculators chase tips and thrills, like gamblers betting big on long odds. Investors study businesses, avoid excessive risk, and expect adequate, not magical, returns. Modern markets can feel like a video game. Tickers everywhere, ads on every screen, lots of data, little wisdom. Classic example. Traders once confused the ticker TMCO, Temco Services, with TMCS, Ticketmaster Online, and sent the wrong stock soaring. 2 minutes of research would have saved them. A good test. Can you avoid checking prices daily? Long-term investors focus on business value, not minute-by-minute quotes. TV targets and hype can move prices in a day, but that doesn't make them sound investments. Here is lesson number 3, a century of market history and humility. In the 1960s and 90s, forecasters promised stocks would keep returning approximately 7% a year because that's what they always did. Graham called that wishful thinking. The future rarely mimics the past. When optimism peaked around 1999 to 2000, high-flying tech names looked safe. Many collapsed soon after, erasing hundreds of billions. Lesson: the higher your assumptions, the harder the fall. Businesses have limits, so should the prices investors are willing to pay. Simple rule: buy low, sell high, yet crowds often do the opposite. Be skeptical when forecasts turn euphoric. Here is lesson number 4, General portfolio policy. There are two intelligent paths. Active, enterprising. You research continuously, select securities, and accept the work. Passive, defensive. You keep a simple, long-term allocation and rebalance occasionally. Age isn't the key. Temperament is. Graham recommends always keeping at least 25% in bonds or cash equivalents to protect against the market surprises. Reassess twice a year, not every hour. The defensive investor and common stocks own stocks, but at sensible prices and from studied businesses. Build a permanent autopilot list instead of constantly shopping. Do your homework. Know what the company sells, how it earns, and what its financial statements show. Familiarity alone isn't analysis. Liking a brand or using a website doesn't make its stock a bargain. Practical aids. Low-cost brokers and automatic dividend reinvestment. Broad, low-fee mutual funds or index funds for diversified, low-maintenance exposure. Here is lesson number 5, the enterprising investor. Negative approach. Why day trading? Hertz day trading is excitement disguised as strategy. Frequent buying and selling piles up costs and market impact, tiny overpayments and undersales that sandpaper away returns. Don't do something, stand there, often outperforms. Positive approach. Quality at unpopular moments. Everyone wants great companies. The catch? When they're beloved, they're often overpriced. Big firms can't grow at rocket speed forever. Financial physics slows giants. Opportunity appears when quality stumbles into controversy. When a blue chip faces a fixable issue and the crowd panics, prices drop to attractive levels. The patient investor buys when great businesses are temporarily out of favor and waits for normalcy to return. Here is lesson number 6. The investor and market fluctuations markets are mood machines. Prices can soar on stories and sink on doubt. A company like the dot-com era's next big thing can rocket, then crater, while still reporting revenue. Later, stronger firms may buy those assets for pennies. Graham's rule: sell to optimists, buy from pessimists. You can't control prices, but you can control expectations. Be realistic about returns. Risk: choose where and how much to invest. Costs: trade rarely and cheaply. Taxes: hold longer to reduce the bill. Behavior: rebalance on a schedule, not on headlines. Buy periodically, sell only for real needs. The intelligent investor can hold for 10 years and beyond, and sleep at night. The final summary: choose to be intelligent. You've learned the difference between investing and speculating, why forecasts fail, how to set a durable policy, and where real opportunities hide. Your financial results are driven less by the market and more by your mindset and method. Be patient. Be disciplined. Think independently. Build a sensible allocation, revisit it calmly, and let time compound your decisions. Stand apart from the crowd and invest intelligently. Thank you for listening. This brings us to the end of the video book. I'm Annie, and it's been my privilege to bring these words to life for you. May the insights and stories you've heard continue to guide and inspire your journey ahead. Please don't forget to like, share, and subscribe to my channel StoryNest VideoBooks so you never miss our upcoming video books. Until next time, stay inspired and keep learning.